Okay, before we start the risk warning, spread betting and CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage. 78% of retail investor accounts lose money when trading these products with this provider. You should consider whether you understand how these products work or whether you can afford to take the high risk of losing your money. Intertrader is a trading name of Intertrader Limited, which is owned and controlled by GVC Holding PLC. Intertrader Limited is authorised and regulated by the Gibraltar Financial Services Commission and registered with the FCA in the UK, reference 597312, registered address, Suite 6, Atlantic Suite, Europort Avenue, Gibraltar. Happy Halloween. You see, we live in the future, so that's been and gone. Right, well, today I'm going to touch on something that I've really been kind of, just mulling over with a few people I've been talking to over the last few weeks. And it's always interesting speaking to as many people as I do, and obviously the kind of different types of traders that I deal with. The kind of Asian, Australasian type market are very different in their approach to to people I've dealt with in the UK and Europe. And it's this idea that kind of there's some massive difference between being an FX trader, being someone that trades the indices or commodities. Again, as I've always shown you, when you start with these kind of 8 screens, then that's the world. That's all you really need to know, unless something massive is moving in the oil markets or the kind of energy markets in general. This is it. This is all you need to know. You understand what's happening in the US with interest rates. You understand what's happening with Brexit. You understand what's happening in the stock market. And gold is your kind of risk on, risk off sentiment. And you understand where the kind of air quotes safe money is going. And a lot of these kind of conversations revolved around the kind of FX market and people fundamentally not understanding really how to trade FX. And a lot of that comes down to people being lazy, if I'm being honest. People don't want to do that little bit of extra research that it takes to trade the FX markets. Now, the big thing that's driving the FX markets right now is interest rates. Now, if you remember, I mean, I've been doing these webinars for a long time now. I talked about that change of looking at growth data, your non-farm payrolls, your GDPs, all that kind of consumerism type data. And I said that the kind of whole sentiment would change and we'd start looking back at inflation data, your CPIs, your PPIs, understanding the relationship between the value of money and, again, those interest rates. So when you look at interest rates, you're really trying to pit a country against each other. And it's not about, as I say, those GDP figures anymore, who's performing best. It's who's controlling those inflation levels the best, who's really got the best central bank. And it's quite an interesting thing once you kind of go into it, because you realize that the world is very different, and there are opportunities everywhere. You've got these little pockets, especially that I've noticed, like when down here in New Zealand and Australia. They've had all that high interest rate scenario, then interest rates have gone down, then they've seen that kind of boom in asset prices, and that's been a good thing. Again, they've got very short memories. They're not interested in equality this side of the world. They just want to get rich quick, buy property and have property in their portfolios. So when you have countries that have been slow to the party with interest rate cuts like Australia and New Zealand have, that when you start getting to those key, really kind of interesting levels of below 1%, and that race towards zero, which it seems to be, then you have all the other questions that are going to come in. Do you go to negative rates? Do you use quantitative easing? And we've seen over the last 10 years what that effect has happened in Europe, what the effect in America has had. We can kind of, you can see it. It's not like it was Mario Draghi and Janet Yellen and those guys back in the day. It was it was people that were kind of making this policy up. They were kind of, okay, we've got this global recession, the global financial crisis, and it's like, what do we do? What do we do to kind of stimulate the economy? What do we do to kind of stimulate this growth? And what do we do? And it all kind of stemmed of this quantitative easing type stuff, and then cutting interest rates low. So again, the borrowing costs for people became more affordable, and that would stimulate growth and that kind of stuff. So it isn't like countries that haven't kind of been through that don't know what's going to happen. They absolutely do, because you will look at the past to predict the future. So if you start cutting your interest rates to record lows and putting money into the economy and addressing things like quantitative easing, helicopter drops, all that kind of good stuff that the central banks do, then we know that fundamentally it kind of elongates the kind of curve. We kick the can a little bit further down the road, for the kind of whole debt type scenario. But it does work in a certain kind of perspective because it pushes those asset prices up and people think they become richer. Now, it's very kind of prominent here in New Zealand that, again, people are literally obsessed by property. Everyone thinks they're a property expert, and the build quality of houses is relatively shit, and the kind of average wage in New Zealand is also shit. So it's amazing that you look in these kind of relatively average areas that the house prices are so high, and that's because everybody is measuring their wealth off the value of their property. And it's very interesting. So when you see the interest rates kind of move around, all the kind of people in those countries are much more interested about how much money they're going to make in the property rather than what happens to their own currency, because it doesn't really matter. Obviously, the currency like their imports are going to get more expensive, so your petrol might go up, your food might go up. But again, that's offset against what you think you're going to make in your main primary asset. So when you kind of look at it from a kind of trading perspective, what you're trying to look at is, again, just simple things like this. Let me just, little kind of really basic things that I've kind of looked at over the years, and it's looking at the country, looking at the rate, looking at the kind of the last move, the size of it. So again, you go back to places like New Zealand, they kind of did that surprise 0.5% cut. So that's kind of messed with the forward guidance a little bit, because you've got the idea that there could be a November cut, and that's been kind of ruled out now. Again, kicking that can down the road, seeing what's happened, shock the market. So when you see that 0.5% come in, then you see there's a big shift in the currency. So New Zealand dollar dropped quite significantly in the days after that because it was a surprise to the market. So if you want to be more in tune with the what's going on, then you just look for the kind of the relationship between kind of what the rates are, what they could be, and then you do your research and you search through and you think Hong Kong. Okay, so Hong Kong never really on the radar before, was it? But all these months of protests, then things are happening. And technically in recession now. So do we trade the Hong Kong dollar versus then you think, well, what's going to be a stronger currency? Yeah, who's likely to put their rates up next? So then you think, well, I mean, look at the UK. What have I said to you about the pound? I've been banging on about there'll be a deal, that the Eurozone's too weak, global economy's too weak, that they'll just find a way of getting the deal through. And I was saying that the pound against the dollar, we're back at 140, 150, 160, and people are saying you're mad. Brexit's 50-50. Brexit's 80-20, and I'm not trying to sit here and say I'm some sort of genius. I was just going with the odds. I was just going with the kind of bigger overall picture. But when you think about the UK, if it does go through a Brexit and gets a deal, and the economy remains fairly steady, then the forward guidance and Mark Carney have hinted that rates could go up, and they're not going to go up anywhere in the world quickly. So we're not talking about kind of getting banked to 2, 3, 4%, that kind of stuff. What we're talking about is a quarter basis point here and there. But obviously, as the market gets so big and so saturated and full of money, that's actually quite a big shift. So if the pound is relatively low, which it is against most currencies because of Brexit, as Brexit is sorted one way or another, and that was my point anyway, even a no-deal Brexit was better than the unknown, that pound becomes more valuable. And if the sentiment comes in, and we think that a rate hike could happen after a smooth Brexit transition, even a 0.25% over the next 18 months, that's going to bring, demand for a very low price pound. And what would you do? You buy the pound over the Hong Kong dollar. So it's not necessarily, as simple as that. As I say, you've got to pick out the currency pairs that are kind of, piquing your interest. But that essentially is how you now trade the FX markets. It's not really about how strong a country is, because again, you can look at strong country data and growth, and it's a little bit misleading, like it is in China. That's historically been very misleading. But then America is massively misleading because you've got record debt, you've got these huge tax cuts that Trump gave to the rich, and although the economy seems doing the best ever under Trump, to use his only, adjective, great. Yeah, well, if it's so great, mate, well, why are we cutting rates? What you trying to do? It can't be any greater than it is. You shouldn't need to cut rates after such a low period of low growth to stimulate or to keep growth going. So again, I mean, just these simple things can be Googled. Again, you keep an eye on the big ones. The eurozone. Again, keep an eye on Germany. The kind of driver behind the eurozone. Other interesting ones, they're coming into the fray, like Norway and Sweden, the kind of the kronas. They're again seen to be more stable, safe haven type thing. So if there is, some kind of backlash against, Brexit when it actually happens, there is some kind of, ripple through to Europe. Maybe, there could be some opportunities in those currencies. Historically, as I've said, the New Zealand dollar and Australian dollar, we've got this interesting scenario where it seems to be a race between zero, but nobody wants to say it, because they all think they've got, the finger on the pulse and they know what they're doing. I live here. Trust me, they don't. I am the smartest guy here by far, and that should be terrifying for everybody. But I mean, there's other currencies, again, things I've never really touched, like Brazil or South Africa, like the rand, etc., and even India. Again, huge kind of currencies. But not to say there isn't opportunity. There obviously is, but as I say, for a kind of longer term trader, as in longer term, as in what I know, I've generally stuck to the euro dollar, to cable, the dollar yen, and I haven't really strayed too much outside of that. But as I say, if you're willing to do your research and you're willing to kind of look at your higher time frame kind of scenarios, the overall trend, then dig back down into those kind of interest rate expectations and where they're going to be, you can see a lot of opportunities. Now, again, these are the basic things that I've told you about a million times over the years, and people still don't do it. If you want to understand what's moving the markets right now, just look. Yeah, just do a search on FX Street. It's dead easy. It's 3 clicks. Do your advanced filters, and then look for your interest rates, look for your inflation. Yeah, maybe your central banks, housing market. Again, because that's linked to interest rates. Not rocket science. Click on all the countries you want, then do apply. Yeah, and then you come out with a nice report like this. What this gives you is potential periods of volatility, and again, your PMIs. Again, at the US, could be, something that will filter through into the dollar. And it's not necessarily that you have to look at the dollar. The dollar is still, the kind of global currency. And it could be any other currency that you've picked out that could be, susceptible to rate hikes or cuts. That could mean, therefore, a strong or weak PMI or CPI reading from the US could be an opportunity. All comes back to that finding value, doesn't it? Something that people have found very difficult to do over the years, looking for value in the intraday markets. So as I say, once you've kind of flicked through, you've got all your Bank of England stuff coming up, plenty of, Aussie data, employment change, that kind of stuff. I mean, the RBA meetings. So all this should do is just pique your interest. And again, this is a, 12:30 my time. So that means it's going to be late at night, but you can still put some orders in the market. You can still look for spikes, have an opinion. At the end of the day, there's bots, black bots, algos, news scanners, trading the markets 24/7 now. So you've always got that liquidity. What you have to be is a bit more pragmatic these days. You have to be a bit more kind of, right, let's set my stall out for the month. What's happening this week? What could that currency or, what's going to move, that market's based upon that data. Then all of a sudden, you're building a framework once again. And, this stuff, when I say, already I can hear people glazing over saying, oh, Steve, that's hard. It's not hard. It's 3 clicks of a mouse. And you can talk about doing, your kind of currency, your analysis, and it take you about 15 minutes. And you've got iView charts like me. You've already got your technical analysis done. So you're talking 15 minutes for the month. That's hardly a big investment, is it? It's hardly a big investment at all. And that's the whole point about my philosophy about trading is, stop reinventing the wheel. Stop trying to make it hard. Basically, I've gone back to basics. I check my charts every hour. And then if I see a trade, I trade. If I don't, I don't. That's it. I don't do any more than that. I'm in my trades, for maybe 10, 15 minutes still. If I like it, I lump in. If, I don't, I'm just out and I wait for the next opportunity. Simple as that. And if you're looking at the kind of currency markets, I've shown you these kind of charts a million times. So again, this is what I'm concentrating on at the minute. New Zealand dollar versus US dollar and GBP versus New Zealand dollar. And yeah, as I say, all these things, look a little bit kind of messy, but they're not. They're basically two trend lines that we're below and going to continue to below and above that we're going to get to and continue above. That's a trend. So from the monthly perspective, okay, what we've seen is New Zealand dollar, bounce off relatively long-term lows, down here when it started that trend, got back to it, but then it's broke it, support resistance. And all we're talking about over this side of the world is 0%. Will they go to quantitative easing? And the thing is, there's relatively low amounts of debt. So if the economy does start to wobble and there is a worry about the house prices, etc., and business confidence and all that kind of stuff, there's plenty of money to throw at it. But that means the currency is going to get weaker. And as I say, against the dollar, although we started to cut rates in the US, you've seen the potential bounce here just from the low and the potential of a higher dollar. But you're talking 4.8 million people in New Zealand versus America. It doesn't really compute, does it? A few sheep farmers and a failing dairy industry. It's basically just a bunch of one man bands over here. Kind of plumbers and tradies and that kind of stuff. Not that I'm putting it down. I do live here. I did choose to live here. I'm just saying the reality. So the dailies, again, I've seen, this is an area of opportunity now. The market has gone from the low back to the high. Yep. So this is an opportunity where the market can kind of consolidate and continue that downward trend. So what I'm looking for is that to be a potential trigger, some good news from Brexit to then look and buy the pound. Because again, what I say, I'm not greedy. So what I'm not doing necessarily is always selling the high in the New Zealand dollar, and certainly not buying, any kind of dips in the New Zealand dollar at all. But I do sell the New Zealand dollar high and buy the pound low. But what I'm looking to do is buy the pound low because I see more positives. I see more things going my favor from my view, from a technical perspective, fundamental perspective of the pound. And again, that all relates to Brexit. It all comes back to, all of a sudden the EU are willing to, kind of bend a little bit, the Parliament, are suddenly, from shooting everything that, the Conservatives have done down, went from, for the vote for the second, go at the general election, we went to, was it 378 versus 20? So it breathed through the House of Lords. So, lots of things are starting to kind of, people not see sense, but kind of just start to do what politicians are meant to do, what kind of the world's meant to be as, that they're starting to bend a little bit, they're starting to negotiate, they're starting to get on with things. So again, all these things are interesting, and as I say, it's from an FX perspective. If you're looking at kind of the markets, from an hourly kind of time frame, what I generally do, you're seeing plenty of volatility. There's enough money in all these candles here that you see to make your 10, 15, 20 pips. So that means a couple of times, an hour, 3, 4, 5, 6 times a day, there's going to be some sort of opportunity to buy that value or sell that value. As I say, if you can be truly market neutral, you can sell high, you're making money. You can buy low, you're making money. 4 opportunities in total if you were, truly market neutral to sell high and to buy low. And again, in the pound, market sells off on some Brexit news or something's not quite as good as the news said. Market comes back down. There's an opportunity to buy. So you look at 1, 2, 3, 4, 5 hours. Yeah, 5 hours of buying on a 15-minute chart. Money, consolidation, money, consolidation, money, and it comes down. So you've got 5 or 6 opportunities just in that 15-minute, kind of momentum buying, for the market to go up. And even when it comes back down, you still got plenty of opportunities to get out. You can still buy it and make some money in the range. It's harder because the market comes down quicker, but you can still buy low, and be selling and get out. And look at your 15-minute chart on the with iView. It tells you buy, pivot, sell, buy, pivot. I mean, people always come to me and say, Steve, I struggle with Fibonacci's. The first thing I always say is, well, go and buy my book. Yeah, there's 2 sections on Fibonacci, strong directional move and overextended move that, you just can't do in webinars. You can't, go into as much depth as something that's actually written. So that's the second step, is just get the charts, because they are from 20 years charting experience, and they are from, just the most logical ways to draw your Fibonacci. So they're always consistent on every time frame. It shows you where the pivot is, it shows you where the market is overextended, and shows you where it retraced to. Again, it took years to make, a system this simple. And, it's amazing that, people still go out there and try and do the technical analysis on their own day by day, from a manual perspective. Should always be automated. You should be able to flick your screens on at any one point in time and know exactly, where value is. That's the key to trading. Where's value at this second right now? Should I be buying? Should I be selling? Should I be leaving it alone? So again, a lot of these have my manual fibs on, but as I say, as you go back through any other, kind of currency, the pound against, the dollar, then, we're above value on the on the hourly, so it's coming back down. But on the 15-minute, bang, you got your sell points, you got your, your pivot point here. It's going to get to here before it goes back up. Your 5-minute, the same. It's peaked across the expansion point a little bit, but it stops and it turns. So just that alone, just that one, kind of point alone, and you got 85 pips just by counting candles closing. You've got an absolute definitive target at 129,445. How easy do you want technical analysis to be? Again, just tie up these things I've told you. Tie up the idea about the fundamentals. That CPI, PPI data. The technicals. Your Fibonacci. Your higher time frame points of interest. Get them all on your charts, and then you're already ahead of the curve. You're already beating the majority of people out there, because people are too lazy to even use free charts or even entertain the notion of where value is, because all they're trying to do is buy low, hold and sell high on a couple of quid a point, and they think that's trading. It isn't. That isn't trading. It's the opposite of trading. It couldn't be further away from trading, even if you wanted to. So a couple of questions. So let me just go through them. What about higher bond yields supporting the currency? Is this correct? Well, I mean, your bond yields, again, I mean, it all is to do with, the kind of the perceived value of, of that currency, and the idea of how stable is that, that government to pay back your debt. So, I mean, the yields are interesting because you've got negative yields, in Europe, and you've got yield curves being inverted. So it isn't quite as straightforward as it used to be honest, Adrian, because we've created a world where we've had ultra low interest rates, we've printed so much money that nobody really knows where kind of true value is. I mean, for me personally, I'm just basically looking at the market movement versus the interest rate. I don't go into any more complexities about the bonds and the yield curves and that kind of stuff anymore, because as we've seen with the LIBOR and the other rates and that kind of stuff, a lot of these things have become manipulated. And although they're relatively simple on the surface to understand, when you dig down into them, they're actually quite complex. At the end of the day, I'm all about kind of keeping trading quite simple. I trade for myself, my own money, so it doesn't matter what I think is smart anymore. I'm trying to reprogram myself to stop being the economist and stop being smart, because if you do that, then you're just trading movement, and you've still got some idea what's happening in the world, but you're less reliant on logical things, to kind of justify your trades on. And that's really helped me, because when I was just trading based upon all the information I knew, all the experience I had, I was doing things, and I almost thought that I was guessing, that I was kind of trying to outguess the Fed or outguess the Trump, or all these kind of different things, and it kind of became very disheartening to be a trader, because you didn't really know what was real and what wasn't. At the end of the day, all I do now is I stick to a simple philosophy, and I've told you this, and I do it even more vehemently than I ever have done. I buy dips in the stock, okay? I sell gold high, right? I always sell the euro high. Tweeted that yesterday. That was a good place to sell. Yeah, not going to make you a fortune, but plenty of red candles to be in and out and making money. I buy the dollar low, I buy the pound low, and that's it. That is all I do. Yeah, I can tell you about, going looking for exotic pairs and delving down into the interest rates. You can do whatever you want. I'm not telling you to trade like me. I'm not teaching you to trade like me. What I'm telling you is the opportunities and what the what the ideals are. If you want to trade 24/7, you want to be able to trade any currency. You want to trade 24 hours a day. You can do all that. That's all available to you in the FX market, but you have to understand why you're doing things. All I have to understand at the minute is how I can get as much size, into these 8 products that I can, and how quickly I can get it out, because that's how I make my money. I'm not interested about being right. I'm not interested about picking the top and bottom of the move. I'm not interested about how many kind of necessarily pips I make. I'm just interested in, can I make a couple of grand a trade? If I can, great. If I can't, I'm not asked. I just walk away, because that's what I do. You, on the other hand, might see the world slightly differently, might see these as opportunities in a different way. At the end of the day, this is the whole point about trading, is there's enough money out there. And that's why I picked the FX markets, because everyone keeps banging on about the stock markets and Apple price and all that crap. There's 4 or 5 trillion traded through the FX markets every day. So somewhere in the FX markets, every hour of every day, there'll be an opportunity to make you 10, 15, 20 pips, right? And that's what you're looking for. But what you can't do, what you can't do is just, be looking for those big moves all the time, because you're trading such small amounts, because you run out of patience, you'll do one bad trade and you'll wipe out a chunk of your account and you start that downward spiral. It's all about being, in a trade, it's right, go again. In a trade, go right again. It's wrong, lose a bit of money, stop, reassess, look at the charts the next 15 minutes, the next half an hour, the next hour. Yeah, you can't just be trading 24/7 and out. It's probably 2 times my entire life that I've traded for 2 or 3 hours, just constantly buying and selling, making money. That was after like major events like the 7/7 bombings, right? Until then, there isn't enough volatility or unknown in the markets anymore just to be constantly in and out and trading, all the time. You've got to be kind of really kind of confining it to kind of 15-minute, half an hour periods, a couple, 2 or 3, 4 times a day in selected products that are moving, because not all products will always be moving at the same time. And that's why I say focus on data, focus on interest rates, focus on something that's coming out that will inject that volatility that you can then jump on the back of. How's it best to learn drawn fibs and the points of attraction? First by yourself, so you know more thoroughly. Just curious. Well, as I said, there's 2 ways of drawing fibs, and it's strong directional move, or it is overextended move. So, I mean, what you just look for is a time frame and a chart. So this is hourly gold. So strong directional move. What's the last strong directional move in gold? Where would you draw it from? Okay, well, you draw it from here, because that's a high, that's a low. So that gives you 50% pivot here. So that means just from what we've seen in gold, back to the 25th of October, that hasn't made a new low, hasn't made a new high, it's held above the 50% pivot. The overall trend of gold seems to be up, because the world's, an insecure kind of, unpredictable place. So what you're doing is that's going to be, your pivot point of breaking your next high, and the market's going to get to here. So just on that movement alone, that strong directional move, last 2 points of interest here and here, that is it. The gold should break through here at sorry, it's in blue, I can't see it. 151799, and if it breaks above that, it should get to 1540. But again, as I say, break that down into a 15-minute chart, break it down onto a 5-minute chart, and you want to be in and out, buying it all the way up. You don't just want to buy here, the stop here, and get up there, because that's not real trading. You want to be trading the movement if that's what you think it's going to do. So that's a strong directional move type thing, and then overextended candle. It's just something like this. Something that looks bigger than the rest of the candles towards the range. Tell me if that works. Bang, comes back to the 50%, makes a new high, can't get back to the 50%, finds perfect support on the 161 spot 8, breaks through the 261 spot 8, and then nearly does a full expansion up to the 423. So just by that one candle alone, buying above the 50%, you have all this opportunity to buy low, get long, and make money. I mean, how easy. But the thing is, I just rock out the fibs and they always work. That's because I've drawn them for 20 years. Yeah. The thing is, you might have the confidence in the fibs and you've got to be drawing them back when they're happening. There's no point drawing it now because it obviously, in perfect hindsight, that's worked well. You need to be doing that when that hasn't happened. You need to be doing that in the future. Remember, this is the future here. So you need to be looking for something like that in the future, then drawing your fibs around it. So, and that's as easy as I can make drawing fibs. Well, it can obviously make it easier. Just get my charts and it does it for you. There isn't anything easy in that because, as I say, it works. So really, I mean, for me, as I say, I'm not going to kind of bang on about the kind of merits of the FX markets because I've generally been a DAX trader for the last 20 years, but I've seen the kind of, not seen the light, but I've seen the benefit of not focusing too much on one market just because, there are certain drivers now that are, driving the stock markets and certain things you can't control, like, the Fed and Trump and, the world's desire to pump stocks up so the 1% get, amazingly rich. So the currencies are becoming a bit more volatile. And again, it's not the volatility I'm necessarily interested in. It's just that if there's a pocket of volatility, I can be in and be out because all I'm looking for is at 10, 15, 20 pips. And, I've got the kind of account and confidence to whack some size in anything. So it doesn't really matter about, as long as I understand the reasons behind the movement and the potential for that movement, then I can be involved in it and I can make some money. And that's really what I'm back to these days, being quite mercenary, just looking for something to move that I've got a relatively decent idea why it's moving, then getting size in, getting size out and banking that money. So that's a really good kind of tip, to use in the FX markets, going back to those interest rate expectations, to go back to the direction of the move, picking out currencies that have that, inverse correlation. To start with, and those inverse correlation of rate expectations and sentiment, and then picking them up, looking for high, low points, buying and selling value. That's pretty much it. Do you ever look at gaps in stocks for the open? What would you look for? You look at gaps in the markets. They happen all the time now. If you see, when we used to do the educational webinars, a small gap in one market is probably a technical gap. A big gap in lots of markets is probably some, fundamental big news event. But it's how quick the gaps close, what they stay in. I generally look for a gap in, gold, and then I look what's happening in the dollar in stocks, because some products are more susceptible to gaps than other. Again, things like commodities are, because of, supply and demand constraints. But, essentially, gaps, are a good thing to look at. They always happen for a reason. Nothing more than, look at the gap direction and how quick it closes. If it doesn't close, then it's obviously something big. I don't go any more complex than that into gaps currently. Anything else? Any other thoughts? As I say, it's kind of the FX market's really what I want to kind of like just focus on right now. And I don't have to drone on for an hour or, I have no time constraints for these things anymore. It's just, basically bringing that point across that if you want to understand how, central banks work, how countries work, and how the FX markets work, then that's what you have to drill down in. And it's not that it's complicated. It could be easy. It could be 15 minutes, maybe, a bit more extended research on some central banks, because you don't live in New Zealand. So you might just check out the RBNZ and say, yeah, actually, they don't know what they're doing. So I'm going to be buying most major currencies against that. Or you look at Australia, or, you look at, again, the Hong Kong market could be an interesting one. Just do a bit of research, pick out some pairs, draw on your charts, draw on your fibs, and all of a sudden you understand where value is. You could be in, you could be out, making some money. That's what it's all about. So not here to kind of say, be some boffin, do some amazing amount of research, Don't. Make it as easy as you can. Get free charts like mine that have all the, technical analysis for you. Check out some central bank stuff of, things that are in the news, because news moves markets. Pick out your products, then trade them by checking your charts every hour. How easy do I want to make trading for you? Well, there's no more harder than that. All right, guys, anything else? Get me on Twitter. I'll be hanging around after that. Ask me any questions, or get me on Skype, Steve Ruffley. As I say, webinars will continue until they don't. I can't be any more mysterious than that. But while they're still here, keep tuning in, keep figuring out ways to make money, and use me, ask me things, because I am here. All right, guys, we'll take it easy, and I'll speak to you all very soon. Thank you.